Hi and Assalamualaikum. My name is Mazidah Binti Omar and I will be explaining on how to calculate for question 1A Roman 1. As for question A Roman 1, it is required to construct the SYDM depreciation schedule for the machine. So first of all, we need to find the SYD rate, which is the formula is N plus 1 times N divided by 2, and N stands for life of asset. In this question, the life of asset is 6, so 6 times 6 plus 1 divided by 2, and you will get 21. Next, we need to find the COA, cost of asset, which is the formula is purchase price plus other associated cost, which is 52,000 plus 2,700 and 3,300, and you will get 58,000. Next, we need to calculate the depreciable value, which is DV, and the formula is cost of asset COA minus salvage value. As stated in the question, the salvage value is 12,000, so 58,000 minus 12,000 and you will get 46,000. After we get those information for SYD rate, COA and DV, we can proceed to the SYD for year 1, which is the formula is 58,000 minus 12,000, and then times with the rate that you get, which is we will start first with the year 6 divided by 21. So SYD for year 1 is 13,142.80 cents, and repeat the same formula for the SYD for year 2, year 3, year 4, year 5 and year 6. After we calculate the SYD from year 1 till 6, we can continue to construct the table, which is the first column will be year, the second one will be beginning value, the third one will be annual depreciation, and the fourth one will be book value. As for year 1, the beginning value is 58,000, which is the COA that we have calculated before, and as for annual depreciation also is the one that we calculated before, which is 13,142 and 80 cents. And to get the book value for year 1, we need to minus, which is beginning value minus annual depreciation, then we will get the book value for year 1. To start for the year 2 beginning value, we need to get it from the book value from year 1, and then annual depreciation for year 2 also the one that we calculated before, and to get the book value for year 2, we need to minus the beginning value with annual depreciation, and we will get the book value for year 2 is 33,904.76 cents. Those and same for the third, fourth, 5 and 6 year. Next, question A Roman 2. It is required to calculate the total tax liability that the company has to pay. So first of all, we need to construct the tax calculation first, which is we need to compute the COA, which is there will be purchase price, which is 52,000, freight or transportation 3,300, installation 2,700, and for the modification is 0. So the total COA is 58,000. Next, we need to find the useful life, which is 6, salvage value 12,000, book value, which is the formula is to get the book value is COA, cost of asset minus accumulated depreciation. We will get 33,904.76 cents, and for the selling price in this question, it was stated that it is 35,000. Next, we need to compare between SP, which is selling price, BV, book value, and COA, cost of asset. So as you can see in the table, the purchase price is 52,000, the book value is 33,904.76 cents, and the selling price is 35,000. As for EBT stated in the question, it is 75,000. And for the marginal tax rate is 35% and capital gain tax is 25%. Next, proceed to calculate the total tax liability that the company has to pay, which is the first one. We need to calculate on gain on recapture depreciation tax on recapture depreciation. So first of all, we need to selling price minus with book value, and then after we get the total, which is 1095 and 24 cents, we need to times with the marginal rate tax, which is 35%, and you will get 383 and 33 cents. And the second one is we need to calculate tax on ordinary business income, which is the formula is EBT times marginal tax rate, and you will get 26,250. As for total tax liability, you just need to add for the number 1 and the number 2, and you will get 26,633 and 33 cents. Next, move on to the question 1B, which is it is required to construct DDBM depreciation. So first of all, we need to find the DDBM rate, and the formula is 1 divided by N times 2. N is life of asset, and in this question the life of asset is 5. So 1 divided by 5 times 2, and you will get 40% for the DDBM rate. And next, to calculate the DDBM for year 1 is beginning asset value times with the DDBM rate, which is for the year 1 is 510,000 times 40%, and you will get 204,000. And the same goes for the year 2, 3, year 4, and also year 5. Next, after we calculate the DDBM rate and the DDBM for year 1 till 5, we can construct the table, which is for the first column is we need to put the year from year 1 till 5, and then for the second column is beginning value, which is the one that we calculated before, and then the second one is annual depreciation for the third column, which is also the one that we calculated before while we calculated for DDBM from year 1 till 5. And then the last one is book value. As I stated before, to find the book value, the beginning value must minus the annual depreciation in order to get the book value. But for the first table is the book value doesn't match as the question stated, which is for the year 5 the book value is 39,657 and 60 cents, because as in this question the salvage value is 50,000. Next, in order to get the 50,000 for the year 5 for book value is we need to construct another table, but first of all we need to calculate first, which is we need to find in the beginning value for year 5 is 66,000 and 96 minus 50,000, which is salvage value, and we will get 16,096. So the annual depreciation for year 5 is 16,096. That is the one that we are going to put for the second table in year 5 for annual depreciation. And then same goes, we need to calculate same just like before, just for the year 5 annual depreciation we need to replace it with the 16,096, and you will get the book value 50,000 as stated in the question. That's all.
Question 2, which contains Chapter 4 Risk and Return and Chapter 6 Financial Planning and Uses of Leverage. A1. For project MCMC, first draw a box with 5 columns and 5 rows and fill them with the given state of economy, returns value and probability. To calculate expected return, multiply the return with probability 17%, multiply 0.20 and you will get 0.034, and calculate the same way for stability and depression. Then calculate total expected returns by adding all the expected return. You will get 6.25%. Then calculate variance by multiply the sum of return minus expected return with probability. Then calculate the total variance by adding all the variance. For standard variation, just press your calculator the square root of variance and you will get 9.26%. For coefficient of variation, divide the standard variation with expected return and you will get 1.48%. For project Cyberjaya, the calculation are just the same as the project MCMC. A2. Risk-averse company means that it is a company that is not inclined to take risks. Therefore, choose companies that are lower in standard deviation and coefficient variation, as low standard means low risk. Therefore, the conclusion should be, if QCQ Digital is a risk-averse company, they should accept and invest in Project Cyberjaya as their coefficient variation and standard variation are lower than Project MCMC. B1. To find the break-even point quantity, first you need to identify the price per unit, fixed cost and variable cost per unit. Then use the formula from the table to find BEP in units, which is QBE equal to FC over SP minus VC. So the quantity is RM 3500. B2. Use the formula BEP sales equal BEP units multiply selling price and key in the numbers and you will get RM 980,000. B3. Profit or loss formula is Q SP minus VC minus FC. Then key in the numbers and you will get profit of 2,640,000 ringgit. Tobishi Incorporation break-even point in quantity in more than 3,500, which is state that the total production and sales is at 20,000 units per annum. Therefore, they gains profit at 2,640,000 ringgit.
Question 3. A. Step 1. Determine the breaking points of each source of financing. The formula for breaking points is BP equal to TF divided by W. From the table, it shows the amount of TF and BP. How I calculate the debt is 300,000 divide 0.4 equal to 750,000. 600,000 equal to 0.4 equal to 1,500,000. For common stocks, 500,000 divide 0.5 equal to 1 million and 1 million divide 0.5 equal to 2 million. For preferred stocks, 300,000 divide 0.1 equal to 300,000. Next is ranges of financing. First range is from RM0 until 750,000. Second range is we have to start with lower numbers to higher numbers, which is RM 750,000 until 1 million. And same goes to the other ranges of financing. For B, step 2, calculate the weighted average cost of capital. Based on the table, we can see the amount. How I get the amount is 750,000 times weight equal to 300,000. Same goes to the next range, but the amount we have to start with 300,000, which is second range we have to start with 300,000, and then 1 million times 0.4 equal to 400,000, and same goes to the next range. For the cost, we have to calculate by the question that given. So for the debt in first range, amount 0 until 300,000 and the cost is 6%. We have to refer to the question given for the next cost of range of financing. For the WACC, we have to calculate. How I get the WACC is by cost times weight. For example, for debt, 6 times 0.4 equal to 2.4 and repeat the same steps until the last range. For the red color, that is the total of amount WACC for each range. Next, C. We have to find the cumulative investment by the initial investment plus the previous initial investment. For the example A, 200,000 and B is 500,000, which is 300,000 plus 200,000 equal to 500,000, and repeat the same steps until F. Based on the graph or schedule, for IRR is getting lower and WMCC is getting higher. D. Which projects should be the company accept? For the company that we have to choose, we need to look at the IRR higher than WMCC from the schedule. The project with higher IRR than WMCC is A and B. So we choose company A and B because the IRR is greater than WMCC.
Assalamualaikum, I'm Siti Binti Omar Azli and I'm going to explain question 4. Now let's move on to the first question of 4A. This question asks us to calculate the earning before interest and tax EBIT indifference level associated with the two capital structures of alternative 1 and alternative 2. So basically, this question asks us to know what is the company's EBIT for them to choose either alternative 1 or 2 so their earning per share EPS level is equal. So as you guys can see from this slide, I already provided a table that shows all the data from the question, which is the common stock, the debt, and also preferred stock of dividend. This table actually shows how to find the new data for alternative 1 and alternative 2 for their common stock, debt, and preferred stock of dividend. Now let's move on to how to find earning before interest and taxes. With the formula applied, the EBIT that I got is 171,928 ringgit and 57 cent. Question 4B asks us how to calculate the earning per share EPS for both structures at the earning before interest and tax EBIT indifference level. So right now we are going to find whether the EPS for both alternatives will be equal or not depending on the EBIT that we got from the question of 4A. With the formula applied, we can conclude that the EPS that we got for alternative 1 and alternative 2 is 39 cent. This means we can either choose alternative 1 or alternative 2 without worrying about the EPS because we got the same amount of EPS. Question 4C. Using the above information from 4B, plot the points on the graph paper and also show the point of indifference. Over what range of earning before interest and tax EBIT is each structure preferred? For this question, I've plotted two EBIT, which is the first is from the question of 4A and the second is the one that I will be showing for next question, which with 600,000 ringgit of EBIT. As you guys can see from the graph, the blue line is for alternative 1 and the grey line is for alternative 2. With the EBIT from question 4A, 171,928 ringgit and 57 cent, both alternative shows same amount of EPS with 39 cent. But with 600,000 ringgit of EBIT, alternative 2 shows higher amount with 6 ringgit and 38 cent, while alternative 1 shows lower amount with 2 ringgit and 37 cent. Now for the last question of 4D, the question asks us if the company expects its earning before interest and tax EBIT to be 600,000 ringgit, which structure should the company accept it and explain the answer? For this question, I used the same formula applied for question 4A, but I replaced the EBIT to 600,000 ringgit. Alternative 1 shows 2 ringgit and 39 cent, while alternative 2 shows 6 ringgit and 38 cent. So what does the answer tell us? The answer tells us that the company have to choose alternative 2 because of its higher EPS with 6 ringgit and 38 cent.
Question 5A, we have to calculate the exchange ratio if merger terms are based on first one, earning per share. We put ideal as AC, FIN3 as TC. EPS TC divide EPS AC is equal to 0.9. Number 2, market price of share. We have to find MPS by our own. The formula is MPS equal EPS times par value. MPS TC 1.8 times 2 equal to RM 3 ringgit 60 cents. MPS AC 2 times 4 equal to RM 8 ringgit. MPS TC divide MPS AC equal to 0.45. Next, C1. Calculate the purchase of FIN3 Berhad equal to MPS AC times ER times NOSTC. 8 times 0.45 times 600,000 equal to RM 2,160,000. Number 2, calculate the post-merger EPS for both companies using the formula 3,100 times 2 plus 600,000 times 1.8 divide 300,000 plus 0.45 times 600,000 equal to RM 2 ringgit 95. For EPS TC, EPS AC times MPS equal to RM 1.33. The table shows that company ID Berhad shown an accretion in EPS and dilution in EPS for FIN3 Berhad. For C3, prepare a post-merger balance sheet under the purchase method. First of all, we have to calculate the goodwill using the formula which is purchase price plus total liabilities minus total assets, and the answer is RM 270,000. For new CS value, 260,000 times par value which is 2 equal to 540,000. New total CS value plus old CS value equal to 1,140,000. For premium, all premium plus purchase price minus new CS value, 500,000 plus 2,160,000 minus 540,000 equal to 2,120,000. New total asset is 5,660,000. For common stock is 1,140,000. Post-merger for premium is 2,120,000. Retained earning is 700,000.